What if I told you that one property could quietly build wealth for you while someone else pays it off? Welcome to MANO INVEST. If you want smarter ways to grow your money, build assets, and think like an investor, make sure you like this video, share it with someone who needs it, and subscribe to MANO INVEST so you don't miss what's coming next. Today, we're talking about real estate investing for beginners. How people build serious wealth with rental properties, the math behind it, the advantages, the risks, and most importantly, whether this path is actually right for you. Because here's the truth. Real estate can build wealth, but it's not for everyone. Let's break it down. The simple framework of rental property wealth. What if someone else could buy you a house without knowing it? That's the quiet power of rental real estate. Here's the simple framework most people miss. Rental property wealth runs on three engines. First, rental income. A tenant pays you every month. That cash isn't just income, it's fuel. Second, mortgage paydown. Part of that payment goes toward your loan balance. Every month, the debt shrinks, slowly, quietly, automatically. Third, appreciation. Over time, property values tend to rise. Not every year, not perfectly, but historically, real estate climbs over decades. Now here's where it gets interesting. You're not earning returns on just your cash. You're controlling a large asset with a smaller down payment. That's called leverage. Let's say you put $30,000 down on a $300,000 property. If that property grows 4% in a year, the increase is based on $300,000, not just your $30,000. That's the multiplier effect. But pause for a second. Leverage cuts both ways. If values drop or rent doesn't cover expenses, the pressure is real. So the real question isn't, does real estate build wealth? It's this. Can you manage the risk long enough for those three engines to do their job? Because when they align, the results compound quietly in the background, and most people don't notice until it's too late. The math example. If I gave you $30,000 today, could you turn it into nearly $1 million? Sounds unrealistic, but the math behind real estate might surprise you. Let's break this down simply. You've got $30,000 to invest. You have three basic choices. Put it in stocks, park it in savings, or use it as a down payment on property. Now imagine you use that $30,000 to buy a $300,000 rental home. You get a 30-year mortgage at 4%. Your monthly principal and interest is about $1,289. Property taxes roughly $400. Insurance around $250. All in, you're looking at about $1,939. If you can rent that property for $1,939 or more, your tenant is covering the cost of owning it. Pause there. That means you control a $300,000 asset, but you only invested $30,000. Fast forward 30 years, the mortgage is fully paid off. The tenant payments eliminated the debt over time. Now let's assume the property appreciates at 4% per year. Historically, real estate has often landed in that 3 to 5% range over long periods. At 4% annual growth, that $300,000 property could be worth around $973,000 in 30 years. Read that again. Your $30,000 didn't grow to $973,000. A $300,000 asset grew to $973,000, and you controlled it from day one. That's leverage. The growth isn't happening on your down payment, it's happening on the full value of the property. And while that appreciation is working, your loan balance is shrinking month after month. Equity builds from two directions, rising value and falling debt. So, is it risk-free? No. Can rents drop? Yes. Can expenses rise? Absolutely. But this is why real estate can accelerate wealth. You're using borrowed money to amplify long-term growth. So here's the real question. If time and tenants are doing most of the heavy lifting, what happens when you own more than one? What about the stock market? What if I told you the stock market could turn $30,000 into over $500,000 without you fixing a single toilet? Let's run the numbers. If you invest $30,000 into low-cost index funds and earn an average of 10% per year, which is close to the long-term historical return of the U.S. market, in 30 years, that money grows to over $523,000. No tenants, no repairs, no phone calls at midnight, just compounding. And that's powerful. Your money grows because your $30,000 is invested in companies that expand, generate profits, and reinvest earnings. Over time, those returns stack on top of each other. That's compound growth doing the heavy lifting. Now here's where the comparison gets interesting. In stocks, your $30,000 is compounding. In real estate, if you use that same $30,000 as a down payment on a $300,000 property, the entire $300,000 asset can grow in value. That's leverage. Instead of compounding on $30,000, you're compounding on $300,000. And while that property potentially increases in value, a tenant may be helping pay down the loan. So is real estate better? Not exactly. It's different. Stocks are passive. You click buy, hold, and let time work. Real estate is active. You manage people, property, and problems. Because yes, things go wrong. Tenants stop paying. Vacancies eat into cash flow. Repairs show up at the worst time. Markets cool down. And stocks aren't risk-free either. Markets crash. Returns vary. Emotions take over. There are no guarantees on either side. The real difference isn't just returns, it's structure. Stocks rely purely on market growth. Real estate combines appreciation, loan paydown, and rental income. Different engines, different risks, different effort levels. So the better question isn't which makes more money, it's this. Which risk are you more comfortable managing for the next 20 or 30 years? 10 essential rental property tips. These aren't theory, these are protection strategies. Number 1, use an LLC. Operate your rental property through a legal entity. This separates your personal assets from the property. If something goes wrong, your home, savings, and investments are shielded. Do it properly. Transfer ownership correctly. Consult an attorney. Protection is not optional. Number 2, get landlord insurance. Regular homeowner insurance isn't enough. You need landlord coverage. Insurance is your first shield, and LLC is your second. Together, they build your legal armor. Number 3, screen tenants carefully. A good tenant makes investing smooth. A bad tenant turns it into chaos. Run credit checks, background checks, income verification. One bad decision can cost thousands. Number 4, consider property management. Don't want midnight maintenance calls? Hire a property manager. They handle tenant screening, rent collection, repairs. But they charge a percentage. Run the numbers first. If it eats your profit, it's not worth it. Number 5, act fast on non-payment. If rent stops coming in, take action immediately. Delays cost money. Know your local eviction laws and involve an attorney if needed. Speed matters. Number 6, understand security deposit laws. Every city has different rules. Some require separate accounts, interest payments, strict documentation. Mistakes here can be expensive. Know the law before you collect deposits. Number 7, buy the right property. Not every house is an investment. Before buying, calculate mortgage, taxes, HOA fees, maintenance, insurance, expected rent. If the numbers don't work on paper, they won't magically work later. Discipline beats excitement. Number 8, build excellent credit. Better credit equals lower interest rates. Lower interest rates mean better cash flow. Credit impacts everything in real estate. Protect it.
Number 9. Understand rental property taxes. Many new investors fear taxes. Here's the surprise. Rental properties often have powerful deductions, like mortgage interest, property taxes, repairs, insurance, depreciation. Depreciation allows you to deduct value on paper even if the property rises in market value. This often reduces or eliminates taxable rental income. Finally, 10. Plan your exit strategy. When you sell, taxes matter. Many investors use a like-kind exchange to roll profits into another property and defer taxes. Others hold properties long-term and pass them on to heirs. Real estate rewards long-term thinking.
Real estate can build wealth, hedge against inflation, diversify you beyond stocks, offer tax advantages, but it requires responsibility. If this sounds exciting and strategic, you may love it. If it sounds stressful and overwhelming, there is nothing wrong with sticking to index funds or retirement accounts. Wealth building is personal. Choose the strategy that lets you sleep at night. If this video gave you clarity on rental property investing, make sure you like this video, share it with someone considering real estate, and subscribe to MANO INVEST for practical investing strategies that actually make sense. On this channel, we focus on building real assets and making smart financial moves. Thank you for watching, and I'll see you in the next video.